Welcome to This Explainer. Today, we're diving into an absolutely empowering investing framework from Peter Lynch's classic book, One Up on Wall Street. We're talking about a completely practical, proven masterclass in finding incredible investments literally right in your everyday life.
So, here's our roadmap for today. We're going to start with a Magellan Fund miracle, look at the retail investor's edge, and then decode his famous buy what you know advice. After that, we'll break down the 6 stock categories, look at fundamentals and when to sell, and finally, wrap up with the true purpose of wealth.
All right, let's jump right into part 1, the Magellan Fund miracle and the absolute legend of Peter Lynch.
Just wrap your head around this number, 29.2%. During his time managing Fidelity's Magellan Fund, this was from 1977 to 1990, Peter Lynch averaged an unprecedented 29.2% annual return. I mean, he doubled the return of the S&P 500 index for 13 years in a row. He took the fund's assets from $18 million to an astonishing $14 billion. To put that into perspective, that is effectively turning a $1,000 investment into $28,000. It made Magellan the best-performing mutual fund on the entire planet. And you know the absolute best part? He did it using a strategy that he firmly believes you, the individual investor, can replicate.
Which brings us to section 2, the retail investor's edge, and exactly why Wall Street is at a major disadvantage.
You see, institutional investors suffer from what Lynch calls street lag. They require strict committee approvals, they have to wait for analyst consensus, and honestly, they're just bound by heavy institutional rules. But you, the retail investor, you're agile. You don't have those bureaucratic chains holding you down. You actually have the freedom to spot a crowded new store at your local mall, or maybe a booming product trend at your workplace, way before the analysts in those high-rises even catch wind of it. In fact, if you find a promising company that no analyst has ever visited, Lynch says you found a double winner. Your everyday life, that is your informational edge.
Let's move on to section 3, decoding buy what you know and building your observation pipeline.
Now, you have almost certainly heard this quote, invest in what you know. It's easily Lynch's most famous catchphrase, but unfortunately, it's also his most misunderstood. Listen, Lynch didn't mean you should blindly buy a stock just because, you happen to like a company's coffee, or because a certain toy is selling well. He meant noticing how packed the local Dunkin' Donuts or Taco Bell is, or seeing how popular a specific brand of jacket is, and using that strictly as an initial lead.
So here's how that process actually works in practice. Buy what you know is really just the top of the funnel. Step 1 is everyday observation. You just notice a trend. Then step 2, kick the tires. As a consumer, you go talk to employees, you test the product, you see if the company is actually expanding locally, and then, and this is absolutely crucial, step 3, fundamental research. You must confirm your local observations with hard financial data. Familiarity reduces your behavioral bias, sure, but the math? The math has to back it up.
Okay, section 4. The 6 stock categories, and knowing exactly what you own.
Lynch always emphasized that a stock isn't just some abstract ticker symbol or an identical financial widget, it is a living, breathing business. And to analyze them correctly, he organizes companies into 6 distinct life cycle categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Classifying a stock into one of these 6 buckets is vital because it determines exactly what kind of earnings patterns you should expect and how you should even measure its success. Let's break a few of his favorites down.
Take stalwarts, for example. These are your large-cap, multi-billion-dollar champions. They deliver moderate, highly dependable 10 to 12% annual growth. Think of those massive global beverage brands or huge established pharmaceutical companies. You buy these as defensive holdings because they provide resilient defense and steady compounding, even when a recession hits.
Fast growers, on the other hand, well, they're a totally different beast. These are the smaller, aggressive companies with roughly 20 to 25% annual earnings growth. And honestly, this was Lynch's absolute favorite category for generating massive wealth. Why? Because these are the companies with the highest potential to become what he affectionately called 10-baggers. Stocks that literally grow to 10 times their original purchase price. You use those everyday observations we talked about earlier to find these ones early.
And then we have turnarounds. These are battered down, near-distressed companies. But the absolute key to this category is that their primary source of financial trouble must be clearly identified and, more importantly, fixable. These offer incredible asymmetric bets. Because they're so beaten down, their recovery potential is just huge, and their success is largely untethered from whatever the general market is doing.
Moving into section 5, fundamentals and when to sell. It's time to do the math.
Remember the third step of our observation pipeline? Fundamental research. Lynch stresses that every investment needs to pass a 2-minute story test. If you can't explain exactly why you own it in 2 minutes, you simply shouldn't own it. You have to ignore the hope of finding the next Amazon and instead actually look at the balance sheet. You're verifying expanding profit margins, rising free cash flow, and making sure total cash balances far exceed any long-term debt.
And this number right here, this is a cornerstone of his math, less than 1.0. Lynch popularized the GARP strategy. That stands for growth at a reasonable price, relying heavily on the PEG ratio. That's the price-to-earnings ratio divided by the earnings growth rate. So, if a company's PE ratio is equal to or less than its growth rate, the PEG is under 1.0. Lynch considered anything under 1.0 to be a massive indicator of inherent value. Basically, it tells you that you aren't overpaying for the company's future.
Now, knowing when to sell is an art, but Lynch ties it directly back to your stock categories. Crucially, your decision to sell shouldn't be based on market panic. It should be based on the fundamental story actually changing. So you sell a fast grower when its growth slows down and it naturally matures into a stalwart. You sell a turnaround once the business is actually fixed because that huge asymmetric upside is gone. And you sell a cyclical when the broader economic business cycle starts to turn downward. See how that works? You let the category dictate your actions.
Finally, let's wrap up with Section 6, the true purpose of wealth, and building a legacy beyond the portfolio. Despite generating vast wealth, we're talking an estimated net worth of $450 million, Lynch famously walked away from managing the Magellan Fund in 1990. He was at the absolute untouchable pinnacle of his career. Why on earth would he do that? Well, because he viewed wealth as a tool, not a destination. Rather than spending more years chasing even more money, he dedicated his life to his family, mentoring young analysts, and engaging in massive philanthropy. He even donated all the royalties from his books to charity. Which leaves us with Lynch's most poignant lesson to consider as you utilize this explainer to build your own portfolio. Once you find your 10 baggers and actually achieve your financial goals, will your net worth serve you or will you end up serving it? Something to really think about. Anyway, thanks for joining me on this explainer. Keep your eyes open out there, do your homework, and I'll catch you next time.